Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and this week I wanted to start off discussing the bond market and the events or bits of news surrounding it from the week prior. So I think the most notable bit of news that has probably caught everybody's attention has been the rising yields and falling prices of US Treasuries. If we look at the 10-year, it is up to about 4.54%, and the 30-year Treasury breached the 5% mark, which is actually a level that has not been seen since before the '08 crisis. Another bit of data that we saw this week with regards to Treasuries was the weak auction demand for the 20-year, and this has been the lowest demand since Feb, which indicates maybe a slight bit of worry about the fiscal trajectory of the US and the attractiveness of US debt. You know, I know previously I've mentioned the auction demand has remained strong, at least in the context of the 10-year Treasury, which it has for most parts, right? Even during Liberation Day and post these announcements. But now we're starting to see weaker demand in the 20-year, and this may prove to be somewhat of a pivotal moment in the assessment and reliability of US debt, simply in the way we think about whether the US Treasuries are the safe haven assets of the financial world, right? And the weak auction demand is maybe, if we see a continued weakness in this demand, it may be a signal that people are looking for alternatives, or they're resorting to other government bonds available maybe in Europe with regards to German bunds or so, right? But let's break this down a bit. So what have been, I guess, the drivers for this bond market blow up in essence, right? And one of them is the US credit downgrade. So Moody's recent downgrade from AAA to AA1 added to anxiety from investors, and the reasons for this were rather obvious, right? Like the increasing burden of the US government budget deficit, which is now about 36 trillion. So what downgrades are going to do is they're typically going to raise the cost of borrowing over time, as investors are just going to demand more compensation for a higher level of risk that they take. And this is just explaining the reaction in the bond market with yields rising and prices falling. Now, another driver has been the tax bill, right? The much coveted tax bill that Trump has spoken about and the entire administration has spoken about. It's a little funny because this bill is estimated to actually add almost $4 trillion to national debt, and these estimates are by economists, and this is on top of the already huge amount of debt, which is, as I mentioned, 36 trillion for the US. So I think this tax bill, while it lowers taxes and will benefit certain businesses, it may even spur economic growth in some regards. The consensus here is that it raises concerns on the government's ability to service these obligations, as interest payments already take up about 16% of fiscal spending as of last year. And I think people are also starting to think that the incremental GDP growth that will occur from the lower taxes and economic growth is going to be insufficient to offset the increase in the deficit, in the budget deficit, and that leads to, I guess, recession worries. And also leads to the weaker demand in US Treasuries, as I spoke about earlier. But going back to the recession worries, it's important to note that tariffs have been delayed or postponed, but not necessarily canceled, right? They've been adjusted, but they're still very much in place, and time is ticking. If we're not going to see deals being cut soon, and if people are not going to come to the negotiating table to actually hash things out, we're probably going to get Liberation Day 2.0, right? And this could be a more indefinite bloodbath for markets, because the uncertainty is going to drag on for a moment of time, a good amount of time, and people are going to start to question how this is going to affect margins of businesses, how this is going to affect inflation, and this brings into question that entire conversation and question around stagflation, right? Could it come back? could this become a reality? Now, in my opinion, I'm going to hold my stance. And on the debt front, I'm going to say that the US is still going to remain the safe asset of the world, despite these short-term headwinds. I think we're in such a headline-driven market that any small bit of news is going to influence the way stocks perform. We're just at such a volatile period. And we've seen downgrades from agencies before, right? Standard and Poor's, as well as Fitch, they both have downgraded the US debt, and I don't think this changes much drastically. But I think if there's anything out of this macro data that I would maybe be a little more vigilant about, is it's going to be the bond auction demand. And if that continues to get weaker and weaker, then maybe people should start thinking about alternatives for a safe haven asset, whether that's gold, whether that's Bitcoin, whether that's, other government bonds. I think it's something that investors should just be vigilant about and maybe monitor. But on that note, I'm going to wrap up the bond and, I guess, macro section of things and move on to earnings. Right, with earnings, I wanted to sort of continue from last week's theme of consumer and retail, as this week we saw a few other big and notable names report, starting off with Home Depot. They reported an EPS of $3.56 adjusted versus an expected $3.60, and this was down 3% year over year and came in lower than expectations. But with revenue, they managed to beat consensus and was up roughly 9% year over year, right? Revenue came in at $39.86 billion versus an expected $39.31 billion. And this value is including SRS Distribution, which it acquired last year. If we look at the comparable sales, so same store sales, it dropped actually 0.3% across the company, but in the US, the same metric, it increased 0.2% year over year, which is a slight positive for the US, but it's not much growth, I guess, if you put things into perspective. Now, if we think about when Home Depot has their peak sales season, it tends to be spring, right? Because contractors and homeowners, their target demographic, just tend to pick up projects because of warmer weather, drier weather. They're probably preparing more for summer, the barbecues, outdoor decks. Just more furnishing happens. I think winter time is a much more quiet period for people to do a lot of work in this regard. And if we look at customer transactions across Home Depot's website and stores, it was up 2.1% year over year. Now, average ticket size, which is essentially the amount of spending on those stores or website visits, was $90.71, which is slightly above average last year, which is slightly above the average from last year, same quarter. But, I think what kind of drove the market's reaction to their earnings call was guidance. As we've seen, guidance has been a strong driving force in how investors react to the stock and earnings, right? And what Home Depot actually came out and did was reaffirm their guidance, which was total sales growth of about 2.8% for the year, comparable sales growth of 1%, gross margin of 33.4%, operating margin of roughly 13%, and adjusted EPS to decline 2% year over year, right? So another thing they mentioned in terms of their forward outlook was that they don't plan on hiking prices due to tariffs, which was rather interesting, especially after last week we saw Walmart actually mention uncertainty about pricing going forward. There are a couple reasons for this, I think. Home Depot and Walmart have different target customers, firstly. Both are big retail players, sure, but Home Depot targets the homeowners and contractors, and Walmart targets your broader consumer. Homeowners tend to be more affluent and have higher purchasing power than your everyday retailer or consumer, which is maybe why I guess the customers for Home Depot are less price sensitive, and their Home Depot's products are maybe less price elastic. If we also look at their supply chain, more than 50% of what Home Depot sells actually comes from the US itself. So unlike Walmart that heavily relies on international suppliers, I think Home Depot has a lot of local sourcing, and their CFO Richard McPhail mentioned that by this time next year, not a single country outside of the US will be more than 10% of the company's purchases, which is again very much streamlining most of their supply chain and sourcing to being onshore to being domestic, which is exactly what the Trump administration has wanted. So it's no surprise that, maybe these guys are more flexible in terms of their pricing strategy, and maybe they don't need to hike prices as much as a company like Walmart does in order to somewhat maintain their guidance. But I still think in this context, it's still ambitious for Home Depot to think that their sales will not be affected. If we look at just the health of the consumer, and this is building off of last week's discussion, delinquencies are rising. Consumers are really starting to feel the pinch. Home improvement expenditure, if you think about it, is such a luxury. And, you know, it's highly possible that people are going to start to delay these expenses for a time where they are more comfortable, for a time where there's maybe less stress on the market. But I think the macro environment will very much influence Home Depot's performance here as a company, right? Not so much as a stock, but as a company and their core metrics and core sales. Now, staying in this home improvement expenditure space, right, another company, another large retailer that reported was Lowe's. Lowe's reported EPS of $2.92 versus an expected $2.88. So higher than expected. Revenue came in at $20.93 billion versus an expected $20.94 billion, roughly around what was their consensus estimates from analysts. And now if we look at comp sales, they were down 1.7% year over year. And this was, according to management, due to unfavorable weather conditions, which hurt sales demand. If we look at sales to home professionals, now that delivered mid-single-digit growth, which was driven by a strong loyalty program and targeted inventory investments. Online sales grew about 6% year over year, and this was supported by, more technology enhancements and the launch of a new online marketplace partnership with Miracle. So if we look at Lowe's strategy, they obviously continue to invest in technology, as do most companies at this point. If you're not, you're basically lagging, right? So they have this AI-powered Milo advisor, their marketplace expansion. They're continuing to invest in their supply chain, store productivity, while also, much like Home Depot, working to diversify their sourcing to reduce exposure from one country, namely China in the case of Lowe's, which is currently about 20% of their sourcing. Again, similar to Home Depot, Lowe's about 60% of their purchases comes from the US, which is again great for managing their supply chain, right? I think because of this, they were able to again stick with their guidance for the year in the sense that they're not tariff affected. Right, and their guidance was sales of about 83.5 to 84.5 billion, comp sales flat to up 1%, operating margin of about 12.3 to 12.4%, and diluted EPS of $12.15 to $12.40. Right, there are a lot of parallels to Home Depot. I mean, the nature of their businesses are very similar. I think the target demographic is similar. So it makes sense that their earnings call and their dialogue around their handling of tariffs tends to be somewhat similar as well, right? They have a more affluent customer base, so maybe they're able to withstand higher prices, a little bit more of an inflationary environment, and because of their domestic and onshore supply chain, for the most part, their Lowe's as a company is probably able to better navigate these tariffs. However, I'm still not convinced by, they've maintained guidance, but I'm not convinced by, sure, maybe they can mitigate the effect of tariffs, right? And maybe tariffs won't necessarily impact them as much as it would impact a company like Walmart. But I think maybe they're not necessarily pricing in weakening consumer sentiment and just the weakening strength of the consumer, right? And I'm not convinced by luxury discretionary spending items at the moment. I don't think people will be upgrading their house if interest rates remain at current levels or even go up, right? People are going to have to pay back their loans, pay back their mortgages. So it's very ambitious to think that consumers will not be affected, even if prices stay the same, right? But if we look at the entire picture, both Home Depot and Lowe's are actually down about 4% for the week. So maybe they had a positive reaction to the earnings call, like a slight jump in momentary pre-trading or for the day. But overall, they're down 4% for the week. I know the market's probably down too, but because we're going to see weaker demand going forward, I think investors have to sort of price that in. Pricing strategies may not change, right? They're a dominant U.S. supply chain, but consumer demand is just likely to falter in my humble opinion. But if we look at both companies, I think there is good that they're doing. They're both continuing to invest in improvements in their supply chain and channel strategy, right? They're trying to diversify and get more of this online approach or, with the marketplace. And I think all that's going to drive incremental progress. But just at the moment, it's hard to see the company-specific growth and benefits overpower the macro picture. Because if your customer is not spending, it doesn't matter how good you are as a retailer, it's going to be hard to convince customers to upgrade aspects of their house or take on larger projects or even take on the small projects that consumers are taking on at the moment. But I think, with these improvements in their supply chain, in the longer term, I think if we see a little bit more trouble and struggle for these large retailers, both Home Depot and Lowe's, if their prices drop a bit in the next few months, I think there could be an opportunity to get in there. Because as businesses, I feel like they are strengthening their systems, they are strengthening their process, and perhaps because of the macro picture, we may see some opportunities arise in terms of entering positions for both these companies. Now, I think the last of the large retailers that I wanted to talk about had more similarities with Walmart from last week, right? And this is Target. Now, Target has been a struggling company for a while. The stock is down about 31% year to date. Top line has not really changed much on an annual basis over the last 4 years. And net income has been roughly the same over the last 2 years. So it's kind of just continuing a trend where this quarter was no bright spark, right? Earnings came in rather disappointing, which has just been the trend for this company. EPS was $1.30 adjusted versus what was expected to be $1.61. Now that's down nearly 3% year over year and much lower than what consensus had predicted. Revenue came in lower than consensus as well, coming in at $23.85 billion versus the expected $24.27 billion. If you look at transactions across Target stores and website, that was down 2.4%. The average amount consumers spent or customers spent during their online and in-store visits was also down by 1.4%. Comparable sales paints a similar story, declined by 3.8% in the quarter compared with a year ago. And if you break that down too, comparable store sales fell 5.7% and digital sales actually grew 4.7%. So we can see this trend of digital first coming into the retail, the large retail space as well. And I think customers are starting to prefer that as well. So while Target did mention that they may have to raise prices, the strategy we are seeing from all these big suppliers is roughly the same, right? Everyone is planning on trying to renegotiate with suppliers and vendors and I guess reassess their merchandising and supply chain as a whole. We see that with Lowe's and Home Depot. We saw that with Walmart, and we're seeing that with Target too. Another drawback, I think, that affected the company earnings this time has been the backlash to their rollback of key DEI efforts. Now, I won't get into details here, as I think there are other forces at play with regards to the broader economy that are more influential in terms of the company's performance, right? This is more just maybe why people have lost a bit of love for the company on a personal level. But if we if we think about what they expect as a company, Target does expect continued sales pressure, right? And low single-digit sales declines for the full year. And this is as compared to a previous forecast of 1% net sales growth. So actually, they're pretty much lowering their guidance, talking about not being optimistic about their future, which is very, very disappointing, I think, for investors in this firm. There's no real strategy here in terms of what we're seeing, or hasn't been much of a strategy in terms of what we've seen over the last few years. They also expect adjusted EPS to be about $7 to $9, compared with the range of $8.80 to $9.80 that it had previously anticipated. And this is excluding gains from litigation settlements. It was hard to, I guess, dig up something decent with Target's earnings call, but I touched on this before. I think one bright spot was digital growth, right? With their first-party digital sales were up mid-single digits. Same-day delivery, which is under their Target Circle 360 membership, was up 36%, and Target Plus Marketplace GMV was up over 20%. So, this has been the one bright spot in their company's operations. If we also look at Drive Up, which is their initiative to order on an app and then drive up to a store to receive it, it now accounts for nearly half of digital sales. So I think Target's pivot to a more digitally involved strategy is only going to help the company, right? This is just a start. And I also think their reduction on dependency on China is going to help them, right? And this will serve them decently at this point. I think I remember reading as of 2017, they previously had 60% of white label brands coming in from China. Now it's down to 30%. So they've halved that. And I think, with a tariff-centric market and with tariff-centric retail products, I think it's just an opportune time for them to have taken that step and continue to take that step in onshoring maybe some of their sourcing and supply chain. Another initiative I think that we heard from Target is the Enterprise Acceleration Office that they spoke about, which the purpose is for this office to look for methods to essentially simplify company operations, use technology in new ways, and just kind of accelerate growth again. So basically just optimize the company a bit better. Some reorganization, restructuring, but we did see a few levers in management, chief legal and compliance officer, as well as their chief strategy and growth officer who left. So these are big executive changes, especially their chief strategy and growth officer leaving. But surely someone's going to have to step in and fill the same role, maybe not in the same title, but we're going to see some additions or adjustments, right? It's hard to say Target is a buy at this point. I mean, company has been struggling for a couple years, and the macroeconomic environment is just getting worse. And I don't actually think the worst is yet. I think the worst is yet to come. I don't actually think we've hit that point yet, because we're just not seeing deals happen, and there's not much news flow on agreements being made. So on a forward-looking basis, this company seems like it's going to continue to struggle in light of tariffs, in light of a weaker consumer, before a turnaround is even possible. But I will say that it would be great to monitor new leadership and who these additions will be when they join and what their backgrounds are, right? Hopefully some reorganization or restructuring will be announced soon, and that may bring some excitement back to this name. I think it has been a company that has struggled for several years and is well overdue for some sort of a turnaround. And if they can take a digital approach, if they can get leadership, and if they can optimize and lean out the company, I think they're poised to maybe stage somewhat of a comeback. That wraps up today's episode, and I'd just like to remind anyone and everyone that I say this each time: none of this is formal investment advice. It is all my opinions, and it's purely for educational and informational purposes. So with that, I thank you all for listening. I'm Anurag Birla, and this is the Finance Now podcast.